Welcome to Assay TV. We're here at the One-to-One Mining Investment Conference. I'm here with Anthony Milewski, old friend of One-to-One Group and the conference here. Anthony, how's things?
Oh, it's great. Thanks a lot for having me today. It's always great to be in Cape Town at One-to-One. It's so busy this year. It's kind of interesting to see the rotation annually in the corporates that are here. You know, this year it feels like there's a lot of gold companies, so that's exciting to see.
Yeah. And how's your take on the market? How are you feeling at the moment?
You know, it's an interesting market. So it feels like, of course, gold is the commodity of interest. But you know, what I find interesting is, you know, what's setting up in the next few years around copper and nickel. And you don't really see investors actually making investment decisions yet. But what you do feel is a real momentum and interest and people thinking about how electrification is going to impact those markets. And, you know, ultimately, where is that supply going to come from for a variety of base metals? And you kind of overlay what's going on in Hong Kong right now and China with this virus. And, you know, you have copper down 13 days in a row now, which is the most consecutive down days for copper since 1971. And you have these contradictions where you have new demand coming into the market for a number of these commodities, and yet you have almost no investment. So it's an interesting contradiction.
Do you think once the virus is sorted out, which it will do when the weather warms up in that part of the world, we're going to see the Chinese government introducing a lot of infrastructure spending, some stimulus spending? You've also got an election year in the US where you might see Trump announcing some infrastructure spending and trying to get the juices flowing again before the election. Do you think we could see a real bounce out of this?
Absolutely. I mean, look, there's no question that especially the US elections, you're going to see people try and bounce. So personally, you know, I mean, I'm buying some copper stocks, you know, some of the liquid names like First Quantum, and some of the liquid stuff like a Nevada Copper, which is a project getting built in the US. So I'm very long copper and kind of waiting here because this virus could kind of, you know, keep the markets down for another month or two. But long term, I'm also very long nickel, you know, nickel names across the board. So I don't think this is kind of the end of the bull market. Although, you know, after a decade, there will be an end. I don't think this is it. And that's largely driven by the US political situation with elections and China's need to bounce back. You know, I've read that to date, this might have cost the Chinese economy, meaning the virus, as much as $60 billion. So it's no wonder that, you know, Chinese New Year, the virus, that things are going to sell off. But you know, I think that's creating a real buying opportunity in base metals in particular, just because of the sell-off and some of the big names, not just the small microcap names.
Absolutely. And your interest in nickel, that's related to batteries. Yeah.
Absolutely. So, you know, when you look at nickel, I actually have the view that the nickel chart is going to look like the palladium chart eventually. And the reason is, you know, if you assume a 30% EV penetration rate, meaning 30% of new car sales are electric, you know, in 2030 or by 2030, you're going to need 14 or up to 14 Ambatavis built. Ambatavi is a nickel producer. And so I just don't know where that's going to come from. And then you kind of think about like what's being built in the nickel space. You know, the Chinese are building a few projects in Indonesia, but really in Canada and around the world, there's not much being built. And so unlike some of the other metals where, you know, for instance, with cobalt, there was artisanal supply that could come in the Congo, other metals have the ability to expand. Nickel, there are simply limits to the supply. And by the way, you know, although completely different, in a lot of ways very similar in copper. And so, you know, the lack of investment is going to cause both of those metals to really run. And it comes down to a structural change that's occurred in the capital markets. You know, when we're at your conference here or any of the conferences, what you see is you see interest from retail and some smaller funds, and then you see very big long onlys buying the most liquid stocks. But for those companies in between, say 100 million and a billion, you know, there are no investors left, and there are very few left. And that means that a lot of these companies are not moving through the development cycle, and there's going to be a real pinch in the pipeline of a variety of industrial metals, you know, at some point this decade.
And those industrial metals are vital, obviously. If the world is decarbonizing and going towards renewable energy, they're going to need a lot more copper, a lot more battery materials. For cars, they're going to need a lot more palladium, platinum, all those sort of things. So actually, we need the mining industry, we need people to invest in the mining industry in order to power the change of the world's energy supply from fossil fuels to renewables.
Well, I mean, that's really the bull case, right? If you take the base case, which is nothing changes, which of course the world is always changing, you know, if GDP growth is 2 to 4%, well, guess what? Like every time you dig a pound of copper out of the ground, like you don't replace it, and fine, there's some recycling, of course, but the reality is that, you know, these things at a minimum need to grow at a similar rate to GDP, and they're not. And so really it sets up for the bull market. And then if you overlay this massive wave of ESG and electrification, because by the way, one of the things which people are just starting to talk about is ESG, and ESG is really all about sustainability, social governance, and I think that's going to put even more pressure on copper and nickel as people look to electrification. And, you know, and a seismic shift that we're seeing, and you can even see it here in Indaba in the conference, is the new pools of capital for mining which are emerging. You know, by and large, those pools of capital have a mandate which is an ESG friendly mandate, meaning the underlying investee company, you know, needs to be ESG compliant. Is not really a term because, you know, there's no governing body, but they need to have ESG principles. And so that's another seismic shift. All of these things combined ultimately mean this decade you're going to have a huge bull market for a number of base metals, which is separate and apart, of course, from the gold story, which is also happening.
And also, of course, there's pressure coming from the people like the car manufacturers, who now their customers want to make sure that all the metals in their cars are sourced sustainably, ethically.
You know, you don't have child labor issues with cobalt. And, you know, I think one of the biggest questions, and you know, we talk all the time, and you guys do a great job of having these conferences in here in Hong Kong and London, and so you guys really have a great flow. And as I've kind of sat at some of your conferences, one of the things that's really, you know, I've not been able to get my head around is the following. You know, look at the number of launches in the last couple of years of EV models. Every single automaker in the world has an EV model. And in fact, all the major automakers have multiple models and have put out press releases talking about the planned model. So basically, every segment of the market, whether it's trucks or inexpensive cars or luxury cars, you know, they all have multiple offerings, and that's going to step into the hundreds in the coming years. So on the one hand, you know, EV sales in the U.S. now approaching 4% of the market. You know, the story is happening. On the other hand, you don't have investment into the basic materials that are going to power that shift. And, you know, each one, whether it's nickel or cobalt or lithium, has its own specific dynamics. But fundamentally, you know, 5 or 6 years out, like it all, you know, where is it going to come from? And you know, I think that reflects really a change in capital markets. You know, when I started my career, there were a huge number of hedge funds and other investment vehicles that could really invest in liquid names and could have a view across multiple years. And I think what you're seeing with the rise of passive investing and the balance of those investors being hedge funds, you have two things. You have the rise of passive investing, which is really buying indexes, buying large liquid names, or you have hedge funds and pools of capital like Millennium and Citadel who are hyper focused on, you know, a 12-month cycle. And, you know, it takes a decade from discovery to building a mine. And by the way, in between you have all sorts of fluctuations in the commodity price. And so it's very challenging for these pools of capital now to take a view beyond 12 months, if it's one type of pool of capital, or across 5 years because it's not liquid enough, and it's creating this huge hole. And you know, and I think we saw 5 or 6 years ago the emergence of private equity firms, or so-called private equity firms, the Orions of the world. But you know, those streaming and royalties and debt instruments that they've tried to put into the market has worked to a certain extent. However, you know, these pools of capital need equity as well. So the system doesn't function, and you know, it's worked to a certain extent for gold, because streaming and royalty companies like Franco-Nevada that trade at a huge multiple to NAV, they have a low cost of capital, and so they've been able to sustain the gold industry. But that doesn't exist for base metals in the same way that it does for gold, and so there's just simply no one to push these things forward. And you know, it's very hard to call. Like, does that mean there's a bull market tomorrow, or in 12 months, or in 24 months? Like no one really knows. But what is definitely the case is that you cannot build a mine in a year. You cannot expand a huge project in a year. And so when it happens, a lot of these base metal charts are going to look very similar to palladium, and I think, palladium and rhodium as well. And I think that's not great, and it's unfortunate that, there's not really a way to kind of sustainably move these projects forward through the cycle. It simply doesn't exist. And I think that's one big takeaway from kind of going around the world at these conferences, is just seeing this kind of real change in the capital market.
I guess the industry also needs to just do a better job of marketing itself to the more generalist investor and some of the investors who are looking to invest in green projects to promote themselves as the suppliers of the green revolution.
Yeah, I agree. And to be fair to generalist investors, like, look at the returns at the S&P. I mean, they've been, astronomical, and you can have 100% liquidity. And so if you're a fund manager sitting in New York or LA and you're thinking about where you can invest, you can go invest in the S&P and get 15 to 30% depending on the year over the last decade with 100% liquidity, or you can invest in some project that may happen or not happen. It's not great for the industry, the Namaska situation, right? You see that and you say, well, maybe I'll just skip the industry. And so that's what's happened. And so I don't think you can really, until we top out the returns in the S&P, I think it's going to be very hard to attract in, these generalist investors. Notwithstanding the fact that they're all long the thematic vis-a-vis Tesla, right? Unless you think Tesla's a tech company, which some investors do, ultimately, by being long Tesla, you're sort of saying that you think that the basic materials are going to be there. And through history, of course, they've been right, but it's very easy to bring a coal mine, to ramp up a coal mine. But if you need to build a complex back end to a nickel plant, or lithium, which is not really a mining story, it's a chemical story, or graphite, how complex is that story? Once again, this takes years. And
the Chinese claiming that they're going to be building these HPAL plants in Indonesia in a very short period of time, but famously difficult to get them to work and get them out under budget and on time. So that's going to drive the compression of.
Well, that's a really specific and interesting point to nickel. So one of the reasons we haven't seen investment in nickel, aside from everything we just talked about, was as you recall from the last cycle, nickel pig iron really revolutionized and crushed nickel, and so I think there's a lingering feeling among certain investors that there will be this ability to transition NPI into Class 1 nickel. And what we've already seen out of those HPAL announcements is that they're probably double over the cost in Indonesia, even run by the Chinese.
Sure.
And so it's not coming to fruition at a price that makes sense. Surely you can convert nickel, but you're going to need at least double from here. So once again, it's back to this point around timing and cost of capital. There are interesting nickel projects around the world. Turnagain with Giga and Dumont and these projects, but each of those requires realistically a higher nickel price to raise the $1 billion of capex or whatever it is, and those are sulfides versus an HPAL plant, which I think HPAL for nickel has been one of the great ways to destroy value. If you look at Goro, $8 billion meant to be 2, or and Batavi, $5 billion meant to be 2. So I don't foresee HPAL as the answer to nickel. I really see the need to build some of these large, disseminated, lower grade nickel sulfides in Canada.
Let's talk about gold a little bit. What's your take on where that's headed?
Yeah, so gold has a perfect storm, right? You have what's really this challenge in the last financial crisis, and I think central bankers didn't know what to do. I'm not a gold bug. I don't wear tinfoil hats, but so they they print all this money, and unintentionally, what they've done by printing all that money has caused massive wealth disparity. Because if you were long financial assets like stocks, you've had this massive bull market. But if you're just a middle class Joe, you've kind of totally missed out on this market. And so now here we are, 10 years on. You've got all these populist politics around the world, whether it's France, the US, the UK with Brexit, a few days ago. So you've got the rise of populist politics. You've got a US currency now buoyed by continuous printing. You've got central banks in China and Russia and Poland buying gold. You've got Russians selling the treasuries. You've got the Chinese allowing the treasuries to roll off. Not a gold bug, I can tell you. I think this is probably the most interesting moment for gold that I've ever seen. I can easily see that gold will go higher.
What would be your prediction for the gold price this year?
I mean, no one knows. I could just make up a number, but it would be a lie.
Go on, make one up.
I think a big driver of gold at this exact moment is not printing. It's not all these things. I think it's actually the virus. So if this kind of 2, 3, 4 months actually causes the beginning of a global slowdown and a recession, then you can easily add a few $100s to the gold price. But if what happens is there's a bounce off the bottom because of U.S. politics and because of the Chinese need to keep things under control, then I still see gold increasing, right? I mean, still you could easily add $50 or $100 this year. I know people are calling for $2,000 gold. Like I don't think anybody knows, right? But I do think that whether it's Ray Dalio and Bridgewater, all these different guys calling gold, I think that it is a perfect storm for gold.
So in this situation, would you be buying physical gold or investing in gold mining companies?
So it's an interesting question because actually gold equities have underperformed gold. So personally, I've done a few things. I've bought 1 ounce gold coins because historically on specific coins there has been a huge premium that's existed because it's a very retail product. So personally, I've done that. And then I bought the GDX, and then I bought really specific gold names. And I find that the GDX, because day to day I'm busy with different things, it's hard for me to follow the nuances of a given story. That sort of a high tide floats all boats. So the GDX works for me, but I think there are some specific names. Like an example is Blackham, right? It's a Walloona project in Australia. It had a history of trouble, but it's large, it's low grade, and if there are options. I really like that kind of style of investing where you pick this big, low grade project out of the money, and then all of a sudden the commodity price moves 20% and the thing becomes worth 30 times or 20 times what it is today. So I have a few kind of options in the portfolio like that. But then personally, and then I own some physical gold with the 1 ounce coins, and then I think the GDX for me really works.
Well, as you mentioned at the beginning, we have quite a few gold companies here at the conference, so I won't keep you. Plenty more one-to-one meetings to be had today. But thank you very much for joining us today for Assay TV.
Thanks a lot for having me.